not that I need to explain myself, but 2 or 3 years ago I made a presentation here. It was October 31, and I was actually dressing up here on stage because, well, this is what happens in our neighborhood when the little kids come trick-or-treating. So in the spirit of Halloween, I've showed you the finished product here, a little bit scary as it is. I'm a partner here at Davidson Company. I belong on a few committees, as well as being on the Public Company Public Company Forum, which is really a roundtable discussion of the auditing firms in town to talk about different issues. It includes attendance by BCSC, Mike Moretto over here on our left. Thanks for coming today, Mike. Carla Marie Haight, and indeed the Institute. So we discuss various issues and upcoming technical matters that affect auditing and accounting in our world today. And so this discussion that I'm going to be going through is on the MD&A, which I think just about everybody has to deal with in your day-to-day lives. So the first place to look about MD&A, and I guess I'm going to walk through a few pieces of this. I'm going to just walk through where we are today with the MD&A, really what the technical aspects are of it, and I'm going to be brief with that because I think we all already know most of it. Then I'm going to go through some of the deficiencies or areas where companies can improve, and then go through some of the regulatory comments where they think we can improve, and then some of the new aspects of a highlights MD&A, and lastly just some of the regulatory updates. So an MD&A, and this is right out of the Form 51-102-F1, it's there to help your current and prospective investors understand what the financial statements show and don't show. We all know that financial statements become quite condensed, a little bit cryptic, and this is a company's opportunity to explain more about their company. That's the intent of the MD&A. It's there to discuss the material information that may not be fully reflected, just a little bit more robust conversation about your company. So that's highlights of it. You're supposed to discuss important trends that may affect your business today and in the future, and provide information about the quality, potential variability, whether past performance is indicative of where you are going. Now, a number of things are required under this Form 51-102-F1, and I'm just going to very briefly go through each one. A date, I think everybody gets. Overall performance, that's really your highlights. What, in a very summarized form, what did your company do? Selected annual information, typically 3 years of information. Discussion of operations, what happened with your company on a little more detail level. Summary of quarterly results. I think that's about 8 quarters, and it's really more of a tabular format. Liquidity, capital resources, off-balance sheet, related party transactions. That's a big area right now, and I'll be addressing that a little bit later in this discussion, but that's a very hot topic. Fourth quarter results. Heck, you've reported on the last 3 quarters. This is your time to report on your fourth. Any proposed transactions, critical accounting estimates, changes in accounting policies, financial instruments, other MD&A requirements. So this is all sitting there in this form. I can tell you it's all also sitting in our audit files, because as part of the review for an MD&A, this list that you see now is what we use to go through that a company has completed the requirements really as put out there by the regulators. So this is what we use when we're reviewing your MD&A, along with a little bit of experience. So now comments from the 2014 and 15, our experience from the audit perspective. Sometimes these documents contain promotional language. It's supposed to be factual, not promotional, and there's a fine line sometimes between that. Usually our MD&As meet the test, but gee, they are generic. They're pretty similar from quarter to quarter. And there is going to be a future focus on those related party transactions. With respect to the related party transactions, and I'll get into further detail yet again, but you've got to name the ultimate beneficiary, the person who received you know, a related party who received some kind of proceeds for the services that they performed to a company. The name of the individual. Relevant for both operating items and for balances due to and or from. And I think you've got to keep in mind materiality, from what we call materiality, perhaps significance in the layman's terms, but I don't think we're dealing with minutia here. I think we're dealing with bigger numbers. Other areas that we see that an MD&A can be improved on is obsolete disclosure. Remember that property I wrote off 3 years ago? I don't think we need to talk about it too much anymore, and sometimes you see a pretty robust discussion about something that really has no bearing with your company today. So remove those irrelevant items. Mention that, you know, just like those numbers 1 through 18, if there's no proposed transactions, say there are none. There's no off-balance sheet transactions. You're recognizing, at least pointing out that you considered it. Just a quick statement, there are none. And tie in the numbers. When we do an audit, there's often adjustments at the end of an audit, and those adjustments sometimes do not make their way to the final product of the MD&A. In our review, we pick that up, but it's something that a company often misses, just as a point for improvement going forward. And very often they require some kind of descriptive commentary, depending on their magnitude. Management's responsibility for the statements, any upcoming pronouncements, and that kind of covers that off, I think, from our experience as auditors. So the next one is comments from the regulatory level, and this involves both discussions with regulators as well as just going through some of their commentary, some of their materials out there on MD&A. Boilerplate disclosure, that sounds familiar to what I call generic. So it's being noticed out there. No discussion of an outlook. Forward-looking information is always is sometimes an issue, and that's like making an assumption but not stating what it is. Magnitude of significance, judgment call. Your company may think differently than a regulator, but you have to keep in mind significance. Non-GAAP measures, another area that's coming to the forefront. If you're using non-GAAP measures in your MD&A, you got to reconcile it back to your original numbers so someone knows how you are obtaining that measure and what relevance it is to the company. And risks and uncertainties. A little more detail now on related party transactions. So the OSC put out a staff notice, 51-723, and I don't know what 723 represents. Could be a really high number. I think that's what it is. I hope it's not the number of reports they've put out. They viewed 100 randomly selected reporting issuers, and 17% required prospective improvement. So that's a comment letter that says you missed something, please put it into your future MD&A. 47% MD&A had overly generic disclosure. That's quite a high percentage when you think about it. Prospective changes required on related party transactions. They requested improvements for 55% of the smaller issuers and 30% of larger. That's, again, pretty significant. So they're looking at it, make no mistake. 40% were asked to disclose the specific name of the related party. And this concept of the name of related party is who received it. If it's Guy Thomas, a director, it should say Guy Thomas, a director, received $10,000 for this service. And very often we actually suggest to the companies that they take the related party disclosure right out of the financial statements where it says, you know, X number of dollars were paid to a director, comma, add the name, Guy Thomas, comma, and then continue your sentence. So it doesn't have to be difficult, but name the beneficiary. 33% were asked to clarify the nature and purpose of a related party transaction. And 4% were asked to disclose the nature and terms of balances due to and from related parties. And I didn't put on a slide, but I did print out an OSC staff notice that provided, and it is the 723, They provided a little bit of disclosure that says this really isn't sufficient, and this is, and I'll just bore you with this just for a couple of seconds here. So this disclosure would not be considered sufficient. During the year, the company paid $120,000 to a director as lease payments. As at December 31, 2014, the amount outstanding was $10,000. Didn't tell you very much. Told you something. Here is the suggested disclosure. I think it's a little bit robust, but that's Guy Thomas's opinion and not necessarily that of the firm. During the year, the company paid $120,000 to Mr. John Smith, the director of the company, as lease payments for leasing the space used as the company's warehouse. The current lease expires on December 31, 2015. The terms of the lease were reviewed by disinterested directors of the board every 2 years and renewed on the condition that the terms are comparable to or more favorable than market terms. As at December 31, the amount outstanding to Mr. Smith was $10,000, which represents the amount of 1 month's rent. It explains a lot, and you might be able to make that a little more concise, but it's an example of enhancing the disclosure of the related party transactions and balances. This is just me again, the handsome fellow on the right would be me, and my lovely wife on the left. This again, man, every Halloween our whole street gets all dressed up for this stuff, and we scare the whatever out of little kids. So recent changes, walking away from the MD&A, not walking away from the MD&A, I'm going to stay on that, but it's going to be a different discussion. Venture issuers only. This is not about non-venture filers, TSX level. This is TSXV. You can do your streamlined MD&A now using what is called a quarterly highlights version. And it's supposed to be a short discussion about the material operations from your liquidity, operations, liquidity, and capital resources, and specifically has to include 4 items: financial condition, known trends, risks, and demands for such things as a product, changes in the use of proceeds from financings, and related party transactions. And it's already in effect, so you could be using this. From a regulatory perspective, it's really meant to be a free-form narrative. Take the gloves off, give the control back to the companies to explain what they think is important about their company back to the companies. Trying to kind of work backward and at a high level, walk away from the regulatory overload. It's supposed to put out what you're working toward, how you're proceeding. For example, in mining, pursuing an evaluation and development by what? Drilling holes, by if you're a manufacturing company, maybe you've got a new market, a new product. At the high level, where are you going? Attempt to alleviate the burden. That's really what this is about, and give that control back to the companies. So this is kind of about giving back to you. The goal is to have you provide a narrative through management's eyes. It needs to be short, it needs to be balanced, and it needs to be accurate. And accurate means non-promotional as well. Should include major milestones. Ultimately, it'll tell the investor where the company is, how it got there, and where the company intends to go in the future. And here's the kicker. Last line. It can be done in less than 4 pages. Possible if you don't throw in that related party disclosure that I just read to you. So bring it down a little bit, but really the concept is, look at our MD&As today. They're 12 pages minimum. They go up to 30. And a lot of that is just boilerplate or meeting one of those 18 criteria. This thing has 4 and is 4 pages long. So for it's something to be considered for sure by companies. BCSE held an outreach session in June of 2015, well attended, I think oversubscribed, so a lot of attention given to it. It is not for larger venture issuers. No. Sorry about that. It is only, if you're big, you are encouraged, and I'm going to be guessing that means very strongly encouraged, to follow the full interim rules, those 1 through 18. MD&A update on auditing standards. Well, we have an auditor's responsibility relating to other information. When we sign an audit report, we have to review your MD&A. There's discussion going on as to just how much our involvement is going to be, to the extent of potentially even putting some line items into our audit report. That will change our world. We're not there yet. And it is supposed to go to, they're supposed to make some kind of decision by the end of October, which we're just about there. I looked 2 days ago, I saw no response, so I really can't tell you what the approval is on the exposure draft. More recent changes, walking away from the bar, from MD&A and going into the bar reports, business acquisition reports, more specifically. They've raised the thresholds here to be 100% from the previous 40%. Also removed the requirement for pro forma financial statements to be included in the bar. The reason is because they expect those statements, or pro forma statements, to be included elsewhere in some kind of management information circular or other place on CDAR. Effective, June 30. We're past it. Prospectus disclosure. Venture issuers, again, reduce the requirement from audited financial statements to be 2 years instead of 3 years. And the business description as well, 2 years. Allows that new quarterly highlights that we just went through, the potential 4 pages stuff, the bar requirements and executive compensation disclosure as well. Venture issuers for audit committees, a little discussion there, must have 3 members, the majority of whom cannot be executive officers, employees, or control persons. That's coming at you. That's effective January 1, 2016, so please keep that in mind. Executive compensation, a little bit of a break here. Disclosure for only 3 named directors, reduced from 5, and disclosure for 2 years as opposed to 3. Eliminates the grant date fair value for summary of compensation table. And again, this is already in effect. That looks redundant. Non-venture issuers, 140 days to report executive compensation. Venture issuers, 180, just to clarify. Now, I had a presentation that I made a while ago to a select number of people, a CFO discussion. And Mike is currently standing up here, I guess, on the slide. What I did was I asked the CFOs to provide some feedback, some input, some questions that we could ask Mike and put him on the spot. Thank you, Mike, for agreeing to even be here. And I'm just going to go through some of those questions, and then I'm going to ask Mike, the best guy in the house, to come up and answer some of them, as well as give you a little more update. Comments were, template or example would be beneficial, a concern, and this was a real one, concern over providing a document that could be considered deficient by BCSC. Sometimes you don't want to be the first person out there, you want to look to other people's examples, so a little bit of reluctance there. And they asked, gee, is there any pre-approval process available? Little clear definition of what is a significant transaction, and I still think that's a judgment call. 30 to 40% of those that were attending that meeting would consider using the quarterly highlights MD&A. So there was some acceptance. They were thinking about it, didn't say they would do it, but they said that they would certainly consider it. They loved some of the benefits, including the removal of that redundant information in an MD&A, and loved the 4 pages for sure. Statement, current MD&A requirements are mechanical and therefore easy in relative for relatively inactive companies. You just keep rolling it over and over and over. But that's kind of back to the original comments of this thing being generic and boilerplate. Sometimes a better finish needed by BCSC. Companies spend time on responses, should receive a response and answers, making sure they're sufficient, and the closing process can be improved. The biggest item here, really, more communication and presentations from BCSC. So once again, thank you, Michael. Little did you know. Use of names. Ultimate beneficiary is now understood. This is with respect to your MD&A related party. But not really well spelled out on the standard. So hopefully today you're walking away with the understanding that in your MD&A you have the name of the ultimate beneficiary for your related party transactions disclosed. And more disclosure is a good thing, increased transparency, and this was a surprise for me. Where's the disclosure about the golden parachutes? Because there were some, I think in the United States, some very, very big payouts of companies for their directors when a company had just been bought out. I think some shareholders were caught off guard, and it's in different places. It's always located out there. You can find it. Sometimes it's not easy to find, and gee, could they put it in kind of one place and make it a lot easier. And that is the end of my discussion. At this point, I would like to introduce you to Mike Moretto, the corporate manager, manager of corporate finance over at BCSC, who can answer not only these questions, but probably a lot more.